Owning property always sounded great until I pictured myself dealing with tenants, late night repair calls, and all the headaches that come with being a landlord. That was enough to send me looking for another way into real estate. And that search led me to crowdfunding, with two platforms popping up everywhere, Groundfloor and Fundrise. Both make real estate investing accessible, but they do it in completely different ways. So in this video, I'll walk you through how each platform works, what the experience is like once you're inside, and who I think each one is really best suited for. Alright, now let's start with Groundfloor, and the real selling point here is that it actually lets normal investors fund real estate loans directly. You're not buying a slice of some giant investment trust. The money goes straight into short-term residential loans, usually for renovations or new construction that normally get paid back in a year or less. And the entry point is ridiculously low. You can start with literally $10. That's not a typo. $10 gets you into a deal. Borrowers pay interest, Groundfloor takes its cut from them, and investors, you, keep 100% of the returns. There are no investor fees at all. It's basically unheard of. Now, Fundrise goes the opposite direction. It's built for people who want to set and forget. When you invest there, your money gets pooled into a larger portfolio. Now, that portfolio might include real estate equity, private credit, maybe even venture investments. You're not handpicking properties. Fundrise's team handles all the acquisitions, management, and everything else. From your side, it's about as passive as it gets. You're getting quarterly payouts and portfolio updates, but you don't actually decide where your dollars go. So once you're logged in, the differences really show up. Groundfloor feels more like a marketplace. You'll see active loans, each tied to a specific property, with details on the location, the borrower, and the terms. Most run about 6 to 18 months, and they're backed by the properties themselves. You can dig in and pick them one by one, or you can use Groundfloor's flywheel portfolio, which automatically reinvests your repayments into new loans. Either way, you see exactly what you're funding, and what you earn is yours to keep, since there are no investor fees. Fundrise, by contrast, feels more like a regular old investing app. You don't see individual projects, you choose a strategy, income, growth, or a mix of the two, and the platform will do the allocations across dozens of different assets. You get quarterly reports and distributions, of course, but you're not deep in the nuts and bolts. One thing to keep in mind though, liquidity is limited. You can only request withdrawals during scheduled windows, and in tough markets, like back during 2020, Fundrise can and has paused redemptions altogether. Now let's talk returns, because that is really what we're all here for. Groundfloor has a solid track record. On fully repaid loans, the average annual return has been right around 10%, and roughly 95% of loans are paid back in full. Now, obviously, defaults do happen, and when they do, the recovery process can drag on, sometimes a year or more. The good news is most loans are secured by property, so even in a default, you don't always lose everything. Historically, only about 1 or 2% of loans have actually lost principal. Fundrise paints a slightly different picture. Their income returns come in closer to 5% annually, but when you factor in property appreciation, long-term deal usually lands somewhere in the 8 to 10% range. So it's not as fast or flexible as Groundfloor, but the whole point is to build steady gains over time. So to make that real, let's look at a simple example. If you put $1,000 into Groundfloor and reinvested at roughly 10% per year, after 5 years, you'd be sitting at around $1,600, assuming no big defaults. With Fundrise at around 8%, the same 1,000 will grow to about $1,470. Now the difference ain't massive, but the feel of it is. Groundfloor runs in short cycles where you can see the deals. Fundrise takes the long road and smooths things out. And if you're looking into Groundfloor, there's an affiliate link in the description and down in the comment section. And we usually have deals there that you won't find if you just go straight to their website, so feel free to check it out. Now another key difference is the fees. Like I mentioned, Groundfloor doesn't charge investors a dime. Borrowers fund the platform's revenue, so your returns are yours to keep. Fundrise, meanwhile, charges about 1% annually when you combine their advisory and management fees. And if you jump into one of their specialty portfolios, like the venture plan, it can climb even higher. Now, it may not sound huge, but over the long haul, that 1% can shave off a sizable chunk of your gains. And it's always important to consider risk when you're investing. With Groundfloor, your money is tied to individual loans. The upside is those loans are secured by real property, often with first lien positions, so investors are first in line if something goes wrong. The downside is that defaults are real and can happen, and resolving them can be slow. With Fundrise, the risk isn't about one borrower missing payments, it's about liquidity and market cycles. If the real estate market slows down or Fundrise freezes redemptions, you might not be able to access your money when you want it. In addition, we need to talk quickly about taxes, of course. Groundfloor returns are treated as ordinary interest income, which means they're taxed at your regular income rate. Fundrise payouts are a mix of dividends and appreciation, so depending on your tax bracket and whether you're investing through a taxable account or something like an IRA, the after-tax results can look very different. And it's worth considering the user experience as well, because that'll tell you a lot about a company's personality. Groundfloor feels like a deal hub. You log in, browse the loans, see the properties, watch repayment timelines, and follow your money directly. Fundrise feels like a polished investing app. You see your balance, skim the quarterly updates, and let the machine hum in the background. One is detailed and hands-on, the other is streamlined and passive. So which one is better? Well, honestly, it depends on the kind of investor you are. Groundfloor makes the most sense if you want to stay hands-on with investments, enjoy short-term cycles, and prefer high-yield potential without paying fees. It's also great for testing the waters since you can start with just $10 and scale up. Fundrise is perfect if you'd rather stay hands off. You put your money in, you let the platform take care of diversification, and you check back in every few months. It's great for retirement accounts or anyone who prefers automation and structure over control. At the end of the day, both platforms are making real estate investing more accessible. Groundfloor gives you transparency and speed. Fundrise gives you convenience and long-term structure. Personally, I think there's room for both. If you want to dip your toe in, Groundfloor is a great start. If you're building a bigger plan, Fundrise fits right in. And if Groundfloor sounds like it'd fit into your investment strategy, check out that link in the description. Like I mentioned earlier, we usually have special offers on our affiliate links that you won't see if you go to the company's main websites. Also, if you're interested in working with us or sponsoring a future video, just reach out using the email in the description below. If you found this helpful, hit the like button, drop your questions in the comments, and subscribe for more comparisons like this. Thanks so much for watching, and I will see you in the next one.